You're watching the global financial architecture unravel in front of you, and you still haven't realized it. Right now, at this precise second, nearly $37 trillion in debt is embedded inside the world economy. That isn't a figure for effect. It isn't exaggeration. It's the documented total. The Institute of International Finance's latest global debt report confirms it: $37 trillion. That equals 384% of global GDP. For context, in the year 2000, worldwide debt was roughly 62% of GDP. In just a little over 2 decades, leverage hasn't doubled or tripled. It has multiplied several times over. And here's the part no one is spelling out. This trajectory cannot hold, not remotely. What you're watching isn't a collection of isolated issues. It's the opening sequence of a single, unified breakdown. It isn't inflation in one corner, a banking failure in another, or geopolitical strain somewhere else. What you're seeing is a single coordinated mechanism unfolding exactly the way it has countless times throughout history. And that mechanism has a name. It's called the Minsky Moment, after economist Hyman Minsky, the precise instant when an over-leveraged system implodes under its own weight. Here's the critical point. A Minsky moment isn't accidental. It isn't misfortune. It isn't a policy mistake. It is the mathematically inevitable endpoint of a recurring pattern. The same pattern that has collapsed empires, broken currencies, and rewritten the global hierarchy again and again. And we are in the final stage of that sequence right now. The structure is simple, brutally simple. 4 chronological phases. Once you recognize them, you can't forget them. And once you understand the mechanism, you stop thinking of the future as uncertain. You start seeing it as predetermined. Stage 1. A new monetary or financial regime takes hold. Usually after a crisis, optimism returns. Activity revives. Credit expands, carefully at first. Memories of the last disaster still linger. Stage 2. Caution evaporates. Debt surges. Asset prices decouple from reality. Leverage becomes the default setting. The culture convinces itself that this time the rules have changed. The system slips into what Minsky called the speculative phase. Borrowers can service interest but not principal. Then it mutates into the Ponzi phase, where borrowers can't even cover interest and must borrow further simply to survive. Stage 3, the spark. Something breaks. Maybe a bank, maybe a nation, maybe an entire asset class. But the psychological shift is immediate. What was considered stable is suddenly exposed as catastrophically stretched. Panic selling erupts. Liquidity disappears. Authorities rush in. Bailouts, stimulus, emergency lending, rate cuts, anything to halt the slide. Stage 4, the unavoidable resolution. Either the structure disintegrates outright or it is rescued through massive currency dilution. Money loses value. Savings evaporate. Wealth consolidates upward. The cycle resets, and the next regime is born. This isn't a hypothesis. It is documented history. And I'm going to show it to you 3 times. We begin with case study number 1, Weimar Germany, 1919. The country has just lost World War I. The Treaty of Versailles demands 132 billion gold marks, around 33 billion US dollars at the time, roughly 442 billion today. Germany is economically broken, its factories destroyed, its workforce decimated, and it now carries a burden it cannot realistically repay. Stage 1 starts almost immediately. Germany introduces a new monetary framework under the Weimar Republic. The Reichsbank, the nation's central bank, is assigned the job of financing reconstruction, war reparations, and social stability. At first, restraint exists. Officials attempt tax hikes. They attempt spending cuts. But political resolve evaporates quickly. The public is drained. So they turn to the last remaining instrument, the printing press. Stage 2 accelerates within a few short years. By 1921, the government is covering its deficits almost entirely with newly created money. Debt to GDP soars. The mark begins to erode, slowly at first, then with violent speed. Businesses and households, sensing where this leads, rush into foreign currencies and tangible stores of value. The speculative phase is underway. Borrowing is no longer for production, it's for speculation. Then the process mutates into a full Ponzi dynamic. The government itself borrows in devalued marks to pay prior liabilities. Workers receive wages twice a day because by evening their morning pay has collapsed in purchasing power. Pensioners starve. Social cohesion shatters. And from that rupture grow extremism, nationalism, and eventually the rise of the Third Reich. The pattern reaches completion. Now we shift to case study 2, the United States in the 1970s. Different nation, different era, identical framework. Stage 1 originates in 1944 with the Bretton Woods Agreement. The US dollar becomes the world's reserve currency, convertible to gold at $35 per ounce. Every other currency pegs itself to the dollar. A new international monetary system takes form, and for 2 decades it functions smoothly. The US runs manageable deficits, maintains gold convertibility, and supports stable global trade. But by the 1960s, fractures appear. The US is fighting the Vietnam War. It is funding the Great Society programs. It is trying to sustain a guns and butter economy. Meanwhile, foreign governments, most notably France under Charles de Gaulle, begin redeeming their dollar reserves for gold. The United States does not possess enough gold to satisfy the claims. Stage 2 accelerates through the late 1960s. Instead of tightening fiscal policy or raising taxes to pay for war and domestic programs, the U.S. expands the money supply. Inflation begins drifting upward. By 1971, American gold reserves are collapsing. The dollar faces intense pressure. On August 15, 1971, President Richard Nixon closes the gold window unilaterally. The Nixon shock. Dollar convertibility dies. Bretton Woods ends. The dollar becomes a pure fiat currency, backed only by confidence and military power. The speculative phase ignites immediately. Oil prices quadruple during the 1973 oil crisis. Inflation blasts into double-digit territory. The stock market unravels. Unemployment climbs. The word stagflation is introduced to describe the unnatural fusion of stagnant growth and runaway prices. The economy is overstretched and fragile. Stage 3 arrives in the late 1970s. Inflation breaches 14% in 1980. Interest rates explode upward. Paul Volcker, newly appointed chairman of the Federal Reserve, drives the federal funds rate above 20% to stamp out inflation. It succeeds, but the toll is severe. A deep recession follows. Joblessness surges. Entire sectors collapse. The savings and loan crisis begins. Stage 4 becomes a reset rather than a total failure. The dollar survives only because of its reserve currency privilege and American military reach. But the burden falls squarely on the middle class. Real wages stagnate for decades. The wealth divide widens. Finance replaces manufacturing as the core engine of the economy. And the precedent is established once more. The U.S. can print its way out of catastrophe. The pattern completes again. Now we jump to case study 3, the 2008 global financial crisis. Same mechanism, shorter cycle. Stage 1 starts after the dot-com collapse in 2000. The Federal Reserve, led by Alan Greenspan, pushes interest rates down to 1% to ignite growth. Banks, drenched in cheap credit, begin lending aggressively. Housing becomes the growth machine. Subprime mortgages, mortgage-backed securities, collateralized debt obligations, a maze of engineered financial products spreads across the system. From Wall Street to small towns, people believe home prices cannot fall. Stage 2 becomes a speculative frenzy. Between 2003 and 2006, home values double in many regions. People with no income, no job, and no assets receive mortgages approaching $700,000, the infamous ninja loans. Banks don't keep these loans. They slice them, repackage them, and sell them to pension funds, sovereign wealth funds, and insurers. The global financial system becomes levered 20 to 1, 30 to 1, even 40 to 1 on the assumption that housing prices will remain upward. It is a pure Ponzi structure. Banks borrow short-term and lend long-term using collateral that exists only on paper. Stage 3 appears in 2007. Subprime borrowers begin defaulting. Home prices peak and fall. Bear Stearns collapses in March 2008. Lehman Brothers collapses in September. AIG stands hours from failure. Money market funds break the buck. The global financial system approaches total paralysis. Credit markets shut down. Liquidity disappears. Banks stop trusting one another. The mechanism snaps. Stage 4 unfolds as the response. The Federal Reserve, the Treasury, and central banks worldwide launched the largest coordinated rescue ever attempted. The Fed slashes rates to zero. It creates quantitative easing, purchasing trillions of dollars in bonds and mortgage-backed securities. The Treasury rescues major institutions. Trillions of dollars materialize from nothing and are injected into the system. And it works, in a sense. Banks survive, markets stabilize. But the bill is paid by savers, by prudent borrowers, by anyone holding dollars. Wealth flows upward. Asset prices inflate. The cycle reasserts itself. Asset prices soar. The wealthy pull even further ahead. And once again, the precedent is locked in. When the machine breaks, the Federal Reserve prints. The pattern completes for the third time. Now we map that same pattern onto the present. We walk through each stage and tick the boxes. Stage 1, the current monetary regime, begins after 2008. Zero interest rates, quantitative easing, massive government deficits, the doctrine that central banks can expand their balance sheets indefinitely with no real cost. For more than a decade, this arrangement appears to work. Stocks climb, bonds climb, real estate climbs. Official inflation stays subdued, at least on paper. The consensus view, the Fed cracked the code. Modern monetary theory gains influence. Deficits supposedly don't matter. Debt supposedly doesn't matter. If you issue your own currency, you can create as much as you need. That was stage 1. Check. Stage 2. The speculative and Ponzi phase. Look at the current landscape. Global debt sits near $37 trillion. U.S. federal debt is around $36 trillion, rising by roughly $1 trillion every 100 days. Corporate debt in the U.S. alone exceeds $11 trillion. Household debt is above $18 trillion. Margin debt in equities hits all-time highs. Private equity is maxed out on leverage, buying companies with borrowed money, piling more debt on them, and then exiting. Zombie firms, businesses that can't even cover interest expenses from their operating income, make up close to 20% of U.S.-listed companies. Cryptocurrencies with zero cash flow reach valuations in the hundreds of billions. Meme stocks, NFTs, SPACs, small traders betting on options with money they don't actually have. Speculative phase, check. Ponzi phase, check. The structure now relies completely on ongoing money creation and artificially low rates to survive. The minute rates rise, or liquidity tightens, the whole construct starts to fracture, which leads to stage 3, the trigger. It's not a future event, it's unfolding now. The Federal Reserve lifted rates from near zero to above 5% in under 2 years, the fastest hiking cycle in decades. The result? Silicon Valley Bank fails in March 2023. Signature Bank goes under. First Republic collapses. Credit Suisse, a 167-year-old institution, implodes and is forced into a merger with UBS. The UK gilt market locks up and needs an emergency rescue by the Bank of England. The US Treasury market, theoretically the safest, most liquid market in existence, experiences extreme instability. Regional banks across America sit on hundreds of billions in unrealized losses from long-dated bonds bought at low yields that are now deeply underwater. At the same time, commercial real estate is breaking. Office towers in major cities trade 50, 60, even 70% below their values from just 3 years earlier. Banks holding those loans are effectively insolvent on a mark-to-market basis. And policymakers have already reacted exactly as the pattern predicts. The Fed opens emergency funding windows. The FDIC guarantees uninsured deposits. The Swiss National Bank provides lifelines to Credit Suisse before its takeover. The Bank of England steps into the gilt market. The Fed has already shifted its stance. Rate cuts are on deck. QE will return, not as a preference, but as a necessity. The system is too fragile to survive without it. The debt load is simply too massive. If central banks stop printing, the entire architecture collapses. Stage 3. Confirmed. Which brings us to stage 4, the unavoidable endgame. And here's what you must grasp. This pattern has only 2 possible outcomes. Either the system implodes outright, deflationary depression, cascading defaults, bank failures, social disintegration, or central banks unleash money creation on a scale without precedent. That response destroys the currency, vaporizes savings, and channels wealth upward in what amounts to the largest silent extraction in modern history. Those are the only 2 paths. There is no third scenario, no soft landing, no gradual glide. The arithmetic won't allow it. $37 trillion of debt cannot be repaid. It can only be wiped out through default or inflated away. And every time governments have faced this crossroads, without exception, they choose inflation. They choose to erode the currency because default is political suicide. Inflation spreads slowly. It hides in plain sight. It can be blamed on war, disease, supply chains, corporate greed, anything but policy. Inflation is the invisible tax, and it is already accelerating. Real inflation, not the CPI theater, runs near 8, 10, even 12% depending on the category. Food, energy, housing, insurance, healthcare, education, all surging. The real value of your savings, your income, your fixed payments is being gutted right now, and the pressure will intensify. This is where people usually object. They say, but this time is different. We're America. We have the reserve currency. We have unmatched military strength. We innovate. We'll outgrow the debt. Let me be absolutely clear. That is delusion. That is denial. It is the same script every declining empire has recited. Rome believed it was eternal. Britain believed the sun would never set on its empire. The Soviets believed their ideology was inevitable. They were all wrong. American exceptionalism is not an economic principle. It's a slogan. The laws of mathematics, debt, and monetary dilution apply universally. When you owe $37 trillion and your entire structure depends on endless growth and endless printing, you are not the exception. You are the rule. The United States is not outside the pattern. It is operating inside it. And the Minsky moment, the psychological shift when everyone realizes the facade is gone, isn't approaching. It has already begun. It is unfolding in slow motion exactly as it did in Weimar Germany in the 1970s and in 2008. The only unknown is the speed of acceleration. So what do? How do you position yourself once you understand the mechanism? First, you abandon the fairy tale. You stop believing your government, your central bank, your financial advisor is acting in your best interest. They aren't. They act to preserve the structure, even if that preservation destroys you. Second, you safeguard yourself. You shift your wealth out of assets that can be manufactured endlessly and into assets that cannot. Hard commodities, property, metals, energy, Bitcoin, anything with genuine scarcity, anything whose value doesn't rely on a government promise. Third, you prepare mentally, because what's coming will be disorienting. Prices will behave irrationally. Markets will swing violently. Narratives will flip overnight. Propaganda will thicken. You need to understand the pattern so precisely that you can see straight through the noise. And fourth, you recognize that this isn't an ending. It's a reset. The passage from one monetary system to the next. It's painful. It's unstable. But it is also an opening. History's greatest fortunes were built during transitions, during the demolition of the old order and the ascent of the new, but only by those who recognized what was unfolding, only by those who understood the structure. The $300 trillion bubble will not burst in a single moment. It won't be one dramatic event. It will be a chain of cascading failures. A bank here, a sovereign there, a market somewhere else. Each crisis will be contained until the day one of them isn't. And when that final link snaps, when the Minsky moment hits in full force, the world you remember will vanish. The currency you trust will be gutted. The institutions you rely on will stand exposed as empty shells. Those who never saw the pattern will be wiped out. But you won't, because you understand the cycle. You've watched it unfold 3 times already, and now you're watching it again in real time. This is not speculation. This is not intuition. This is a structured analysis of a repeating historical engine, and that engine is unmistakable. Stage 1, new regime, check. Stage 2, speculative mania, check. Stage 3, the trigger, check. Stage 4, the resolution, already underway. The pattern is complete. The Minsky moment has arrived, and whatever follows will redefine the global landscape for the next half-century. If you want to understand how we reached this point, who engineered this system, why they engineered it, the dates, the decisions, the architecture, you need to watch the next video, because none of this is accidental. It was built deliberately. And once you see the structure, you'll understand why escape was never an option. Subscribe, enable notifications, and prepare to see the machine for what it actually is, because the clock is almost out. The moment has already begun.